Yo. I don't know if anyone's here or not. If no one is, that's fine, no problem. If you are, hey, welcome. I'm just gonna get all market view, multi-chart view on the M30 time frame. So I'm gonna keep this on, so we can kind of just see what happens with all the markets. We've got DXY in the daily right here. Everything else is on the 30-minute time frame. So we've got eurusd, gbpUSD, USD/JPY, gold, US30, oil, Bitcoin, DXY. I might get rid of GBPUSD and just swap it for USD/JPY. And then I'll swap Mr. Fomc. Yes, my friend, that's the statement release, and obviously we get the press conference at 7:30. That's the one we're going to be really looking for. My friend's streaming at the same time. I was like, damn it, why are you streaming? I can do a poll. How do you do polls? Yeah, start poll. That's cool. Can I not do the poll myself? Oh, I can't do it myself. I think only you guys can do the poll. Yeah, press conference is 7:30, and then obviously it's going to be about half an hour. So I think the first half hour is where most of the stuff happens. So it's going to be interesting to see what happens, that's for sure. Can you see the poll? Okay, cool. So you can. I can't. So what's it gonna do? eurusd, USD/JPY, gold, say USD, S&P 500. Probably do Nasdaq or US30. US30, Dow Jones, Bitcoin. What should I do here then, man? I need to do one more asset. eurusd, USD/JPY, gold, S&P 500, Nasdaq, and US30, Bitcoin. Probably do oil over here then. It's a commodity, isn't it? sure IC Markets does. Yeah, XTI oil. Perfect. Yeah, WTI. It's each broker has a different name, doesn't it? Like each broker has their own specific name for it. So, yeah. So for me, it was. Oh, what the hell? Did I misclick it? Yeah. Where's the one for? Where's it gone? IC Markets. I found it and then it disappeared. There you go. Got it now. Yeah, so Euro, USD, USD, gold, oil, S&P 500, US 30, Bitcoin, and DXY. Perfect. I think this is going to be interesting. See if we can... The statement's coming out literally in a minute. Get it all ready.
One minute remaining. I'll lead with the US interest rate decision.
Perfect. Oh, only if I could split the gaps and spreads are going to be wild. Yeah, they are. Yeah, they are. Very wild. Trust me, bro. Trust me. Let me just split this. So you got the chat and the, there you go. Perfect. Let's go.
Ten seconds. Cut 25 basis points, cut 25 basis points, cut to 4.25% as expected. Current year rate forecast at 3.625%, 3.625%. Lower than the expected 3.875%.
Look at the spread.
Rate forecast at 3.375% as expected. Over the next 2 years, 3.125% as expected. And over the next 3 years, 3.125% as expected. Long run at 3% as expected. So the Fed say downside risks to employment have risen. The median projections show 50 basis points more cuts in 2025. So again, Fed median projections showing 50 basis points more cuts this year. Cuts the target rate again to 4.25% and says Governor Moran dissented in favor of a half-point cut.
Raw.
So Fed officials' median view of the Fed funds rate at the end of 2027 at 3.1%. Median view of the Fed funds rate end of 2028 at 3.1%. Longer run seen at 3%. Again, the projections implying 50 basis points of cuts this year, 25 basis points of cuts in 2026, and 25 basis points of cuts in 2027. The projections show that 9 of the 19 officials see 2 additional cuts this year, 2 see 1 cut, and 6 see no more reductions. Policymakers see a 4.5% unemployment rate at the end of this year, unchanged from the prior forecast. Again, the projections show one policymaker estimated the appropriate policy rate by the end of the year was 4.5%, unchanged, and one saw it at 3%. Policymakers see the end of this year's PCE inflation at 3%, unchanged from the June projections. Core seen at 3.1%, unchanged as well. So looking to the market, strength in the S&P 500, weakness in the dollar coming through here following the release of this latest SEP.
Oof. So how much of a jump was that? That was a 35. It's gonna keep going now. Shit. Yeah.
The Fed policymakers in the SEP see 1.6% GDP growth this year versus 1.4% in June. And they see the longer run growth
look at it go.
1.8% unchanged from the June projection.
You might hit 137 on the pound. Yeah, 137 hit on the pound. Holy moly. Okay, so Fed rate forecast next year, 3.375, 450 pips on gold. Let me have a look. Holy moly, bro. Yeah, mate, big move. Fold. Bro, if you shorted or you long, you would have got slapped on both sides of that. Look at that candle. It's disgusting, bro. It took the high and it slapped the low. This is why you don't trade gold. This is why you don't trade gold. Oh, wow. Okay. So they're expecting to go down another half basis point. Couldn't. Fed prediction implies an additional 0.5 basis point cuts for this rest of the year. Only 0.25 in 2026 and only 0.25 in...
to bets on at least one more Fed rate cut this year.
The Fed median projection shows 50 point more cuts. Right, so what's the Fed watch tool saying then? Let's look at the Fed watch tool. This is getting interesting. This is getting interesting. We need to look at that press conference, bro. We need to see that press conference. So boom diggity, September's done. October, they've got a... Okay, wait. So that's accounted for now. Now, in October, there's a 72% chance of another 0.25 basis point cut.
The main point of contention from the SEP here. So they're seeing a further 50 basis points of cuts this year in the dot plot. We've posted the link to the full SEP on the site as well for those interested. Again, this led to weakness in the dollar, government bond yields as well, strength coming through in the US indices. And US rate futures now pricing in a total of 69 basis points of cuts this year following the Fed statement, which really is little changed from before.
Bruh, there might be a trade here, man. I'm really tempted to get into a short on M1 if I get confirmation. The trade was for longs, bro. All of this level building up liquidity, swept these lows casually going up. Either with a wick down, took all of this out and flew up, or it just took this out and flew higher. And obviously on EURUSD, like that high there, that high there, that high there. So like it just signified.
Disconnected.
Why did it disconnect? Why did it disconnect? One sec. It's connecting. I think the website's having a meltdown. Yeah, it's having a meltdown. So yeah, basically on EURUSD you had all of this here, yeah, that needed to get taken out, and then this just did it right there. Beautiful, man. I think I do want to take shorts. I can't be bothered though, man. It's gonna be after Fed meeting and stuff in it. Okay, so Fed projections. Okay. So Fed projection shows 9 out of 19 officials see 2 additional cuts in 2025. 2 see 1 cut and 6 see no more reductions. So 9 out of the 19 say there's 2 more cuts. Yeah, I bet it is. let me. Oh no, CHF took these highs. Now CHF is gonna drop down. Okay, let's go back to gold. Go on the M1. Okay, so this is like, okay, we're going down. This candle, maybe not. Oh yeah, we're going down. Look at USD/JPY falling off a cliff. Dollar down. Oh, has it took that low? Oh my god, it's took the low. It's took that low and it's falling. Wow. Okay, so we broke that level. We've broke that low now that we had in July. Right. So the next level this could go to. The next level we're gonna get on DXY now is gonna be around about here. So this level here, I'm guessing
yield falls back below 4%, near last week's low.
Bro, tomorrow's gonna be lit. Tomorrow's gonna be lit, bro. But remember, you got GBP. Actually, you trade gold, so you're all right. Tomorrow's gonna be a good day for you. I think price is gonna have this next level of contention now. The 96.2 to 94.5, basically. That's gonna be the next level where we might find potential support. But I think that support is gonna fail. Wow, wowza! Look at that weekly candle, bro. Look at weekly, bro. Wick. We can't find buyers. NFP, FOMC, to the downside. Fantastic. Absolutely hilarious. Gold is gonna rip now, bro. Gold is gonna absolutely fly off the back of that. Oh my god. Pound is killing it. Look at that. Oof. Fed policy makers see 4.5% unemployment rate at the end of 2025 versus 4.25 in June's projections. Fed officials median view of the Fed rate funds end of 2028 is 3.1% at the end of 2028. Fed projection shows one policymaker estimated the appropriate policy rate for the end of the year to be 0.25 to 0.5. One saw it to be 2.75 to 3. Wow. Fed policymakers see 1.6% GDP growth in 2025 versus the 1.4 in June. See longer run growth at 1.8 versus 1.8 in June. Wow, there's a lot of data being thrown out, bro. This Fed meeting is going to be huge. Traders add two bets to at least one more Fed rate cut this year. Fed downside risk of unemployment have risen. So the Fed saying, look, unemployment's not looking good.
Futures pricing in a 94% chance of a cut in October following the Fed statement. It was at 71.6% before. Rate futures pricing in 60
You're right, Zach. I agree, Francis.
Following the Fed statement, little changed in total.
So let's just keep looking at the Fed watch tool because I'm expecting that's going to go up and down more and more with the statements coming out. The Fed watch tool, I'm literally looking at it right here. See? And keeping an eye on that as the statements come out. This is what the Fed says what we're expecting, innit? So 75% chance in October getting another 0.25 cut. In December, we've got 68% chance of another cut. So 3 cuts are really likely, or 2 more cuts are very likely. Oh, look at the
Spot gold hitting a record high.
Spot gold hitting record high. Yeah, it is, isn't it? Yeah, look, there you go. 30707. 707, yeah. January 350 to 750. 350 to 750. So in January, there's a 50% chance of another rate cut, which is that one cut they mentioned. There's only a 20% chance in March, which is very low. In April, there's a 30% chance. In June, there's a 40% chance. So they are saying that later in the year, they are looking. Right, okay. That's interesting, isn't it? It's gone up now. So October's gone up to 95% for one rate cut. December's gone up to 93%, 93.7 for another rate cut. Yeah, this is interesting. Market's pricing it in. Market's already pricing it in. Let's look at the news outlets, see what the news outlets are saying. Federicus point mediation shows 50 basis point cut for 2025. Governor Miran dissents in favor of 50 basis points cut today. Fed says downside risk of unemployment has risen. Fed officials see no more cuts in 2025. 6 people said that. 9 people said 2 more cuts. The Fed is shifting their focus to the labor market because the labor market is one that's deteriorating, isn't it? So it makes sense. It literally makes sense. So come out as 0.25. Whoever picked 0.25 on the poll, well done, man. Okay. US interest rates price 94% chance of a Fed cut in October, which is what we've just seen. US rate futures pricing a 69 basis point cut. Price in about 69 basis points of cuts in 2025 after Fed statement. Little change from before. See, I love this stuff because you really need to understand how it affects the market and stuff like that. I was the only one that voted, I think. well done. It says 3 people. So on the 1 minute chart, if you would have got like higher low, higher high, lower low, lower high, lower low, you could target back into this low. But what's the pip volume on these candles? Yeah, mate, 12 pip candle. Yeah, mate, 5 pip candle. Yeah, mate, 7 pip candle. Yeah. I think price might start rejecting at these levels because we've really gone up. Like we've gone seriously high. We've taken out some good levels, man. Let's go to M5. How much pip movement have we had? We've had a 70 pip, 68 pip move, which is a comfortable move. And then we've had 72 pips on Euro USD.
So after the rate decision now, we're seeing gains in the US stocks reversing now. S&P 500 down spot 2%. Nasdaq down spot 7%.
Oh god, yeah, let's look at the S&P.
8%.
Oof, look at the S&P 500 and the US 30. Oh my god, that's bad. That's bad for stocks. That is not good for stocks. Look at that. Oh my god, look at the S&P 500. Oh my god. That's a big move right there, bro. That's a big move for the S&P. We're talking 0.6% in a matter of about 5-10 minutes. You know, if you trade the dollar, looking at the S&P and stuff like that is really important because they're all interlinked. Bitcoin's down on it, makes sense as well. If we're getting risk off market, Bitcoin's going to fall off of there because people aren't going to park money in Bitcoin if they haven't got spare money to trade. Oil's down off of that. Gold is still kind of undecided, but gold's going to rally regardless. All this uncertainty and stuff like that is just going to help gold rally. We've already made a new all-time high. And now we're just getting a pullback before we make another move to the upside.
Hello everybody, this is
Trust me, gold's going to keep going. 150% gold's going to keep going. Probably get 320 today, 325.
At financialjuice.com/purchase and save 67%.
I'm going to keep on M5 on these.
Isn't it one
Actually,
big, huge, brilliant deal? Come
have you got
on,
another high? Yeah, we have got another high set there. So I like how GBPCHF took that level and started rejecting straight away. So low, that led to a high, that led to a lower high, lower low, lower high, lower low, lower high. So it could have tried to catch a sell in there, but I wouldn't catch a sell in here with the prop firm. I was the only one that went. Yeah, sorry guys, it's still the same thingy in it. Yeah, this is mad. I can't wait for the press conference. I can't wait for the press conference. The Fed inflation has moved up and remains somewhat elevated, and they've already mentioned that obviously the downside as well of the unemployment or the employment. Yeah, it's not looking good for the US, man. Oh, we've come to the weekly low. So we've come taking the weekly low on the DXY. What the heck? What's going on here? Yeah. That was weird. So price has come down here. We've had a rejection. Let's go back to the daily now. This is so interesting to me. The yen is gonna fall off, is that which it is? We've got resistance level up top here as well. It's not looking good for stocks, Zach. It's really not looking good for stocks. If you draw a fib extension on the 30-minute candle, it shows that the next level is 3720. Well, that's what I'm guessing anyway. I'm just forecasting 3720. I expect that you'll get another 200 pip move to the upside, and then you start to pull down slowly, and then Asia will consolidate. Then London, you might, as you said, I agree with what you said earlier about how price moves like that. Oh wait,
US 10-year yield falls below 3.99% to lowest since April.
I'm waiting for the press conference. It's going to start shortly. It's a lot of it is timing and stuff like that. The first year of presidency is always a bit crazy, and it makes sense. And look what Trump's done. I'm going to eat some food during the press conference. So I'll be on mute just watching it. Wow, man. The spreads were not as bad as what I thought they would be.
So in 10 minutes time now, at the bottom of the hour, we get the FOMC press conference with Chairman Powell. We have posted the live video to this on the feed for those interested.
This is going to be good. This is gonna be interesting. I appreciate you sitting here with me, Sak. No one else turned up. Screw them. Yeah, I appreciate it, man. Oh dear, look how gold dojing so hard. I bet it's waiting, I bet all the gold traders are waiting for the press conference to find out where things are gonna go. Man, that was a big move. Yeah, of course, you won't get a big crazy candle, but you will get big moves, yeah, because if they ask a question, yeah, that Jerome Powell gives a serious insight to, then it could lead to big volatility. The statement is what it is. The press conference where you get the real juicy information and stuff like that, because that's where people ask the question, are we going into recession? If he says it signals like we are, that's really bad. If he says, do you think that we're too late on the rate cuts, like too late on the rate cuts, and he says, I feel like we are slightly late, that's really bad. So these things are going to push the dollar even further into, like, it's just going to make everything worse. So the press conference is better because you get to question the statements and he has to answer the questions. But sometimes he doesn't really answer them, he just gives like a very vague answer. So that's why the press conference is the main move of FOMC, not the statement, but the actual press conference itself, which is kind of the main thing to watch. That's why I'm waiting, just to find out what they say. Right, I'm gonna be right back. I'm just gonna go grab some food really quick and then we can watch the conference. So just give me like a few minutes and I'll be right back, okay?
S&P 500 rebounds back in positive territory.
And Powell beginning the presser. Fed's Powell says unemployment remains low but has edged up. Inflation has risen recently and remains somewhat elevated. Job gains have slowed, downside employment risks risen. Powell repeats that inflation has risen recently and remains somewhat elevated.
You're behind the markets. If you're a real... Well, hello, everybody. This is Donald J. Trump. You're behind the markets. If you're a real day trader, go real time at financialjuice.com/.
I didn't get the pizza.
and save 67%.
In our
on
summary of economic
subscription.
projections,
Isn't
the
that
median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the market slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we have begun to see goods prices showing through into higher inflation. And actually, the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And it's also possible that there may be effects on unemployment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening, or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our policy.
So just looking at the SEP once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since really since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
I think a follow-up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. You know what? Let me say a word about the SEP really here. So we often point this out. What the SEP is, it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you gotta be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that, but it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just, everybody who's at the Fed really feels strongly about that way. So, You'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? You know, that's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and people they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies, and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. A black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter, and I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You see minority unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Bank Federal Reserve system and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college, and yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down, and so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret some of his speeches, for example, and then some of, the forecast that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you had about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there are a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Right.
Thank you, Archie Hall from The Economist. You mentioned earlier that job
Let's see
creation
what
was
his question
running
is.
below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
Oh, ignore that.
So there are many different.
Yeah, man. That was interesting for sure. Oh my God, I've gone black. Oh my God, I'm black. Oh my God. 1 second. There you go. Let me just drop the volume on this to there. Go there. So basically, I think it's interesting what they're saying, yeah? Because at the start of it, it's like, oh yeah, we've done a cut because things are looking a bit sticky. But then he turned around and he said, oh, we can cut rates slowly. Things are kind of within where we're expecting them to be. Things are manageable and stuff like that. So for me, it's kind of the initial stance was quite dovish, yeah, which is quite bad. Oh my God, they're cutting rates because of unemployment and stuff like that. But then he's come out and said, but we can control it, we can cut slowly, we're not in a rush to cut, yeah? So, to be honest, I think the DXY is still bearish. I'm still bearish on the DXY after that press conference. But I think that we might find a short-term low. I think for the next 1 week or 2 weeks, you might see slightly bullish price action. I wouldn't be surprised if we just come back up again to like 97, 98 and then reject off of that level again. So I'm still bearish on it, but I'm just expecting this to now kind of give it a chance to breathe back up again, back into these levels, 98.8 or something like that, 99, and then drop from there. So that's what I think anyway. They did price in rate cuts, 3 of them, but then when he made the statement that, oh yeah, we're not exactly, what was the statement I copied and pasted? Fed Chair Powell says the Fed was right to wait and don't need to move quickly to cut rates. And then the S&P 500 fell and stuff like that because they benefit off of rate cuts stimulating their economy and stuff like that. So if they're saying they're not exactly quick to cutting rates, been here 20 minutes. Oh, Habibi, why didn't you say anything? I was like, no one come. It's just me and Sak and Khalil, who's, I don't know where he is now. So then I was just kind of like, right, okay, that doesn't look like. My speaker, one sec. Okay. I'm just waiting for OT to fix his mic. Ali, have you done it yet or not? But yeah, I think that this is gonna find support for the dollar, man. Yo, Ali, where are you, man? Yeah, anyway, I think this is going to be potential short-term support for the DXY. After that, I expect it's going to continue to go bearish after that, especially the data keeps coming out negative for the DXY. So that's pretty much me done for that. Thanks to everyone who come to the stream. I appreciate you. I appreciate everyone, including everyone who came, all that stuff. Thank you. See you tomorrow for London session. Let's see how the market ends the day and starts tomorrow. Peace out. Bye.